Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields, still holding that range, basically unchanged week over week, but as a weekly settlement goes, matching that from last week, we have to go all the way back to April. It continues to, I think, surprise many, not ultimately huge because we are holding in that 280, 290 range, but we are nearing the lower end of that range, and the market doesn't seem too scared, and we've made many attempts at this 280 level with unsuccessful ability to hold it. I think the key level in treasuries to the downside yield remains 275, a level we haven't seen in a long time, and that will be the oops moment for all those shorts out there that are likely to start getting more squeezed if they haven't already. So right now, we held the range. We're settling near the low of that range, 280 to 290. Implied volatility, yeah, it's telling us that there isn't really much going on because we're holding the trend. Now, despite political geopolitical risks overseas, we have Fed risk, policy risks here, we have God knows economic risks as well. There are a lot of risks and a lot of variables up in the air, but the market, the implied volatility is simply watching what the market's doing, and it is holding that range. If it breaks out of that 280, 290 range, I think we're in for a major spike in volatility, something we haven't seen in a while. But again, we haven't seen that yet, and the market doesn't seem to fear that happening. And if we saw a trade below 275 yield, that would only exaggerate the move, the spike in volatility. Again, something that we haven't seen in a while, but it could come if we see a major breakout in the range. And what could break us out of the range? Well, next week we have Fed Chairman Powell speaking to the House and to the Senate, and it looks to me now, after we saw his testimony released earlier today, that he's going to continue to kind of play the game. Yeah, gradual rate hikes look good. We're happy with where inflation is, jobs, and everything. But ultimately, he has some questions to answer. One of his concerns looked to be about the labor participation rate and also that pesky yield curve, which continues to flatten. You look at things like, you look at 2s, 10s, you look at 5s, 30s, whatever it is you look at, it continues to get flatter. And the flatter we get, the closer to inversion we get, and the more we have to start talking about when and what's going to happen when we hit inversion. Is recession going to follow, or is this a new dynamic given what the Fed has done over the last 10 years? So ultimately, I think those are the questions he's going to have to answer. The market is priced pretty solidly for a rate hike in September. But after that, it's pretty much a 50-50 guess whether they go again, and I think the market needs more data. We also heard from some of the banks giving earnings today that their second half of 2018 expectations are very cloudy, which, again, is a reflection of a flatter yield curve and a Fed that really doesn't know what it's going to do. It needs to see the growth numbers, needs to see a sustained inflation trade. Likewise, we need to know really how the market is going to react if the Fed becomes more aggressive, because right now they are doing gradual rate hikes. I think that the market is accepting that very well. However, if the yield curve continues to flatten, if yields continue to decline in the back end like we are seeing and holding at the low end of those ranges, the Fed could have some explaining to do, but that's not until next week. This is Todd Colvin coming to you from the floor of the CME Group.